last class, I was I had just entered options. Students, so tell me what an option is.
Option is a segment in derivatives, sir.
Yeah.
So
And
futures in
It's a contract.
Yeah, go ahead.
It's a contract.
Yes, it's a contract. And what does it resemble?
Right to buy.
So it resembles insurance contracts, basically, right? So an insurance contract is a right to protect yourself from whether it is fire, health, or life, or whatever it is. But for that, what do? You just pay a premium and you get the right to protection. You don't have to exercise the protection. You will exercise it only when the event occurs, right? When health issues come, or life, when somebody dies, or when fire happens and you get damaged, then only the exercise. So it is a right, but not an obligation. So in an option, you pay a premium. And what right do you get? You get the right to either buy or sell. Okay. So a call option is one in which it benefits you by purchasing a call option if you think the price is going up. Yes. A put option is the other way around. You think if the price goes down, you'll buy a put option. And then what about option? Every option has what characteristics? So it is either a European or an American option, number one. Most of the time it is European, which is exercisable only at maturity, meaning that every option can be converted to underlying shares. Okay. Every option can be converted to underlying shares. So that is called exercising at a particular price called the strike price. Okay, students. So I will show you now on the Nifty, some Nifty options. So this is the platform you're going to do your assignment on, options. So I'm going to say options here. So, so this site is so beautiful that you can go back and do your back testing. So let's go to option simulator. Simulator won't come in this, it will only come in this, but never mind. So we will just go to options and we will go to options dashboard. Okay, so many different companies and indices come. So we choose Nifty here. Okay. Okay. I want this basic call option. Maybe it will come under my options dashboard. Okay. Strategy builder. We'll say options. Okay. So every option will either be a call option or a put option and will have a strike price. Okay. So what is this? So we will say, we will choose a strike price close to where we were yesterday. So which is where, students?
16,220.
16,200. Let's just choose. Okay. So let's say we are choosing a 16,000. So look at this. Every option has what? An expiry date. I have chosen this expiry date. Yes. And I have chosen strike price of 16,200. Okay. So now if I do add position, now it tells you what are the probabilities of profit I have. Okay. So it tells you maximum profit. It can be anything. If the price keeps going up, look at the premium, your break even. Yes. So what is the value of this option here? That is the premium paid. 16,200 call option. Its value right now is basically the premium you are going to pay. And that is about 16,469 minus 16. Yeah. So you see that value there, 268.55. Can you see that?
Yes, sir.
So that is the premium you are paying to buy this option. Okay. Now, in every option, there are two components. What is this? What are the two components? How does the premium calculate? Yes.
Underlying asset and the last date.
Yes. So basically, two components are causing this premium. One is intrinsic value. In a call option, the intrinsic value is calculated as market price minus strike price. So what is market price here? What is the market of the Nifty here, students? 16,228 or something, right? Yes?
Yes, sir. 16,228.
Yeah, 16,228 is the market price minus the strike price, which is 16,2,000, which you just chose. So 28 rupees is intrinsic value. Yes. What is the time to expiry? How many days do we have? 19 days. So 28 is intrinsic value. Remaining 240 is time value. Are you understanding, students? Yes, no?
Yes, sir.
Yes, all of you understood?
Yes, sir.
Yeah. So if you don't understand, please ask me, I'll explain again. So market intrinsic value and time value. So most of this options value is time value. Okay. Hence the probability of profit. Look at that. When you choose an option strategy, you must choose an option strategy when your probability of profit is greater than 50%. Okay, students? Then only you should buy an option. So in this case, since the probability of success is so low, I am better off selling the option provided I think the market is going to go down. Okay. So here is my option strategy that usually works. When I think the market is going down, I will sell options with low probability of profit. Okay, students, are you clear on what I'm saying? Okay, right now the trend is up, so I won't sell this, but let's look at this. Now I will change this to put option. Okay, students. And I click add position. So this is what? This is a put option expiring June, and the 16,200 put is 248. Okay. Okay, so if an option has intrinsic value, what do we call it?
In the money.
Yeah, in the money. And if it is not having intrinsic value, if it is, what happens when the option is exactly strike price is equal to the market price? So if let's assume Nifty was 16,200. What would you call the 16,200 put and call?
At the money.
Correct, at the money. And if it was anything beyond 16,300 call, would be out of the money. Now, 16,200 put. This is very interesting, guys. 16,200 put. Is it in the money or out of the money?
In the money.
Put. Call is in the money,
Okay.
right?
Okay. It's the other way around.
Correct. So the put option is out of the money, right? Because in this case, strike price, right, is greater than the market price, right? Or the market price is greater than the strike price. So if it was 16,300 put, it would be in the money. But 16,200 put, yes, is out of the money. Okay. Is that right?
Yes, sir.
Yeah. So 60, but look at this though. If you look at this, very unusually, the out of the money put option is showing a larger profit, which should not be the case, right? Yes, students. It's showing almost 45% chance of profit. So that is telling you that many people are expecting the market to probably go down rather than up. When the out, yeah.
The two trades are there. Sir.
Yeah. Go ahead.
In that strategy, call option is also there.
Oh, that's probably why. Thank you. This I have to remove. Thank you so much. I was wondering why it was showing. How do I remove that now? There's a way you remove this. 1 minute. Edit position, trash this. Yeah. Okay. So that tells you that. So now that's better. So I was very surprised because both were added. Now, if you look, the put option, again, this is out of the money. The probability of profit is less. Yes. Okay, students. So this is only the put option. Yes. Out of the money. Thank you, Mahesh. I almost missed. So so here, probability of profit is 34.77. So now this option again is telling you this strategy may also not work. Only 34% chance of profit. So what do I want? So to be successful in options, you want to be correct on what? By the way, how do I calculate the value of a put option? Intrinsic value of a put option. Students?
So the strike price minus whatever the
20
market
rupees.
price.
Strike price minus market price. So in this case, there is strike price is 220, sorry, 200, but market price is 228, right? So there is no intrinsic value. So the entire 248 you see is time value. Yes, the 19 days of expiry, entire 248 you see is time value. Are you clear? Yes? Yes, students?
Yes.
Okay. Now I want to improve. Remember, probability of profit, I want to improve. Okay. Okay. So let me see if I can go for a deeply in the money option. So I will edit this and trash this. So give me a in the money option here. So I will go for 16,000 and I will go call option. And now I say add position. Now look, even now the probability of profit is not that much. And look at the premium you are paying. 393. Okay. Now let us assume that we are an exchange and we want to sell options. Okay, students. So what are we going to do? So I'm going to flip this. I'm going to say sell and I'm going to sell out of the money option. So which call option should I choose? So let's say I'm going to sell 16,300. So I'm going to sell this. I'm going to edit and remove that. So I'm going to sell an out of the money call option. I don't want to sell this call option. I want to sell out of the money. Sorry, we'll trash this. Call option, out of the money call option is what, students? 16,300. So I'm going to sell this, add position. Look at my probability of success here. 66% success. So more out of the money, more is my probability of profit. So if I sell this option and market goes down, then the chances are what? The chances are very high that I'm going to make money, 66%. So always when you buy options, use this site to track. Okay, students, use this site to track and see and take options that are giving you high probability of success. Okay, students, are you clear?
Yes.
So if you sell out of the money, chances are they are going to go worthless at expiry. You may be making money. Now look, I go deep out of the money. And let's say 17,000 or I'll go 16,850. I'm going to sell this call. Okay. I'll edit that. I'll remove that. Now I'm going to sell this. Look at my probability of success here. 82% chance of success. Because between now and 19 days, not many people think the market can go up 500 points. It has sometimes, but the chances of that are only 18%. Okay. So selling out of the money options is probably the way to go. Yes. Now you may say a crash may happen. Yes, but that's a low probability event. Crashes are usually low probability events. Any questions, students? Any questions you are having?
No, sir.
Okay. So I discussed all of these strategies. So for every option, you will have an expiration date. Expiration date is usually every Thursday. Stock options expire only the end of the month. Yes. There will be a strike price. Okay. It will be in European or American. Most Indian options are European, and it will be a call or a put. And in the money, out of the money concept, I just revised. Last class, I explained in detail. So if the Nifty is at 1800, at the money would be 800 call and put. In the money would be 8700 call and 8900 put, and out of the money would be 8900 call and 8700 put. So students, are you clear on this? In the money, at the money, out of the money?
Yes, sir.
Yeah. And then I also, yeah, go
Is
ahead.
there any one option, like, in the money, at the money, or out of money? Is there anything that we have to choose, like anything that's something that we have to always rely on?
Okay. So like I said, always rely on a strategy where your probability of profit is highest. Okay. So typically in option buying strategies have usually low probability of success. Option selling strategies will have high probability of success. And when you sell out of the money options. Remember, we have to always sell in the direction of the trend. Meaning, if you think Nifty is bearish next week, I would be selling what options? Put or call?
Put.
I would buy put, but sell
Yeah.
call. Remember, you're saying the market is bearish, it's going down. So I'm going to sell call options. Remember, selling options will make you money long run, but it will require you margin. And what options should I sell? Options which I think will give me the highest probability of success. So out of the money options. So if I am bearish next week, I'm just saying example, don't take my word for it or anything. Just if I am bearish next week, the high probability option trades I can take are selling out of the money call options. Just now I showed you out of the money call options if you sell. Similarly, if I'm bullish next week, what will I do?
In the money.
I would just sell out of the money put options. I'm
Okay,
bullish,
sir.
right? I think market is going to go up. Okay, so I will sell, I will buy call options, but buying call options have low probability of success. Yes, as you saw in the Ostrich screen. So what will I do? I will sell if I think the market is going up. When I'm selling, I am collecting the premium, right? Basically, I'm collecting the premium. So I will sell out of the money, put options if I think the market is going up. Is that clear to you? So that's how you decide what to do. Yes. Many people think they can make a lot of money by buying options, particularly out of the money options. But for out of the money options, price has to move extremely in one way, in one direction in a given period of time. So hence, very difficult to make money by buying options. Only the exchange itself makes money selling you all the options. They are the ones. So there is a strategy, statistic that says that 87% of all options expire worthless. So when some 87% of things are expiring worthless, should you be buying or selling? You should obviously be selling, right? And of that 87, almost 90% of those options are out of the money options. Almost 90% of all options that expire are worthless or out of the money options. So basically, you can make a lot of money if you sell out of the money options and sell in the direction of the trend. That is the number one thing. First, you should know the trend. If you think the market is going down, you will sell out of the money call options. If you think the market is going up, you will sell out of the money put options. Is that clear to you, students?
Yes, sir.
So if you do this, you can make consistent money over time.
Sir,
Yeah.
Sir, rather than exercising the option at the expiry, can I just exchange the contract with someone else?
So basically, you'll just sell the contract before expiry. Nobody will exercise it.
No, I'm talking about buying the option.
So, okay. So when you're buying the option, if
Yes.
it goes up in value,
Yes.
right? If the market moves in your direction, the option will gain value, right?
Mhm.
You can just sell it and make a profit. But
Yeah,
remember,
so
when you buy an option, you should be right both in time and direction.
okay. So, but I'll still lose the premium.
So when you buy an option, here's the deal, right? So let's say you bought an option today at you are buying the in the money nifty option, which we just saw, 200 call option. It was 260 bucks, right?
Yes.
So if the market tomorrow goes to nifty goes to 400, this 260 will become 400. So you can
Yes.
make about 30% profit on it. So you can exit.
Okay, but a smaller profit will not be able to.
Meaning?
Uh, let's say the profit is and that stock barely moved a little.
So if the stock sometimes barely moves, then your premium from 260 will go to 200. So you will actually lose money.
Yes. So I still will lose the premium.
Yes, you will lose
Anyway.
on premium. Your 260, which you bought for, will suddenly go to 200. And you would have lost 20% when the stock really moved very little. That's the risk with options. There is something called theta decay, right? So as expiry date reaches closer and closer, the premium will keep on decreasing.
Okay.
So the premium will decay. So once you pay a premium, that doesn't stay the same. As you reach closer and closer to expiry, it will decay like anything. And let's say you bought the 2,200 call and Nifty closes at 190. Today you are paying 260 on expiry date, it has become zero, right?
Yes.
So this is the risk of buying options. Rather, you'd sell it. But when you sell, you should sell in the direction of the trend. Very important. Because suddenly the market can go up 5% and you will be making more loss than you have put in.
Yes, sir. Okay.
So you should sell in the direction of the trend. So
Yeah, okay,
next
thank
week,
you.
next week, if you think the market is going down, I would sell out of the money call options that expire on Thursday. Similarly, if you think it's going up, I would sell out of the money put options that expires the Thursday. Yes, is that clear, students? Yeah, students, clear?
Yes, sir.
Yes.
Any other doubts or questions you have, students? It's very important to grab the concept of options, understand the basics.
Sir,
Yeah,
I mean, this is just a general question. In
yeah.
the previous semester, when you gave a guest lecture, you mentioned that, I mean, it is not advisable for any person to do a short trade depending on technical analysis. Hello?
Yeah. Did I say that? Yeah.
Yes, sir, you did. And in this semester, we are actually learning about that. So,
Yeah. So what I would have probably said is in a short trade, you can lose more money than you can put in, right? So let's say you sold something short and it went up. You are losing more money than you put in, right? You have to buy it at higher levels. And so there'll be a loss. So let's say you short sold something at 20 and if it goes to 200, then you will lose 10 times your money, right? Correct?
yes, sir.
So it is risky. However, in options, that is not the case, right? Because options are decaying assets, right? They are losing value. The premium is being lost, right? So that's why I said, because if you think you know time and direction, and you can predict with certainty, then you can sell options, particularly out of the options, and make money. Unlike stocks, which have a particular value to them, options are decaying assets. They keep losing value. So hence it is advisable to sell options, but not individual stocks. Individual stocks, yes, you can if you are very sure it's going down. So for example, let's say there is a questionable company which has no earnings or whatever, and it is traded at a very high valuation. You can take a short position, but it's very difficult, right? Sometimes it takes time for the short position to play out. In options, that is not the case. Immediately it starts going down because there is decay associated with option prices. Did I clear that up, Kirti?
Yes, sir. Yes. Thank you.
Yeah. So you are wondering, when you can sell, you said it's not advisable to sell stocks. Why are you asking me to sell options, right? That was your question, right?
I mean, I was wondering then if it's not something advisable, like why are we learning about this?
Okay. Yeah, fantastic. So it is very advisable to sell options, but remember, when you sell options, you have a very high margin requirement. Okay, you can't just go and sell an option just like that in your account. So for example, if I want to sell an out of the money Nifty call option, so here's the requirement, right? You can see down, if I pull up, if I were to sell this 6,850 call option, look at this. I have to pay 68,000 in margin in my account. I have to have 68,000 in my margin account to be able to sell it. All right. So you can't easily sell options. So, but 68,000 I will have in my account. 68,500 call is 38 rupees. So if I sell one lot, my margin requirement is 68,000. So 68,000 margin I have to sell one lot, and I'll collect 38 rupees in premium. Yes. 38 means 38 into 50, 1,900 rupees in premium I collect. So if this option expires worthless, I get 1,900 at the end of the month, credited to my account. Is that clear?
Okay, sir. Yes, sir.
So it is an income strategy. But for this to happen, I have to be careful that the Nifty doesn't go above 16,850 on expiry. Yes?
Yes, sir.
So
Thank
right
you.
now it's saying the probability of that happening is only 18%, Nifty going to 16,850. So it says no net credit 1940. This is the amount you will get in your account by selling this option.
Yes, sir. Got it. Thank you.
Yeah. Any other questions, students? Good question, actually. Okay, students. So then getting back to topic again. So now we'll get to the interesting part. So I also showed you an example of put call parity. We did put call parity, right? The last class. And arbitrage using put call parity. Yes. So the put call parity equation will tell you whether your option call or put option is underpriced or overpriced. And based on that, we did a sum numerical. Yeah. Okay. So, Gurleen, you had asked this question. What happens if I just keep holding my option, what happens? So sometimes if you hold your option and the position moves against you, then the premium will keep coming out of the option because there is time decay associated. Yes. Also, many people will just keep the option if the trend is strongly. So if I buy a call option and the market keeps going up, should I exercise? Probably not. Just keep holding it. Once the premium keeps going up and up, once it goes quite a bit, get out. Yes. But you should know when to get out, because once it starts going down, then the premium will leak out of those options. Okay. Now we come to the very, 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 very important part, students. This is trading strategies involving options. So what are the different strategies? Remember, always we will execute these in Opstra Edge and make sure we have a edge on that. And remember, always test your strategies on Opstra Edge before you put any money to work. Execute only high probable strategies. Okay, now we are going to get into trading strategies. Okay. So there are many trading strategies that we can come across in options. One, you can take a position in the option and the underlying asset. Okay, students. Take a position in two or more options of the same type. Yeah, that also you can do. And then take a position in a mixture of calls and puts. So this is called combination without the underlying. Last one is. So you can either take a position in option and underlying or combine options. Take up position in options only. Yes. Take options positions in calls only or puts only, or combine both, which is a combination. Okay. So the first one is hedge with a protective put. Students, I have already done this numericals in Excel, so you can just follow along. If you open the sheet, okay, so let's look at this. Let's look at a scenario where you have a stock. So you think the stock is going to decline. So what do? You buy a put option. So let us look at how we can make money in this scenario, and when we make money, when we lose money, etc. Okay, students? Okay.
Yes, sir.
So look at the stock price. I have two columns here. The first is the gain or loss on the stock. Yes. Next is the gain or loss on the put. Okay. Remember, when you calculate gain or loss on the put, gain or loss on the put, you will always subtract. Remember, in this case, you are taking a protective put. When you buy a put option, what do? You pay the premium. So that minus 45 you see there is the premium. So now let us look at loss on stock. So at what price did he buy the stock? He bought it at 440, right? If it goes to 0, he's going to lose all the money. Yes? Yes, students?
Yes, sir.
And at 150, he will lose 290. You just subtract 440 from all those things. And if it goes above 440, obviously, he's going to make money. Okay, students? Now, gain on loss on the put option. So how do we calculate the put option's price? Put option has strike price of what? 425. Yeah, students?
Strike price, I mean the difference between strike price and whatever we have paid into lot, no sir.
Correct.
Number.
So the how do you calculate the value of the put option? It is nothing but strike price minus market price. So at 0, the value of the put option will be 425 minus 0. Then you also paid a premium of 45. You subtract that. So your put options value now is 380. Yes. Gain or loss on the put is 380. The put options value is 425. Plus you paid a premium of minus 45, which you have to subtract. So your gain or loss on the put is 425 minus 45, that is 380. Is that clear? Clear to you, students? Students?
Sir, could you please come over again?
Yeah, so gain or loss on stock, you understood, yes?
Yes, sir.
So, okay. So how about gain or loss on the put is nothing but value of the put option minus the premium paid. Yes. And how do we calculate the value of the put option? It is nothing but strike price minus market price. In this case, the option which we have chosen is 425 put. So the strike price is 425 throughout. Value of the market price is 0. So 425 minus 0 is 425. Minus the premium paid is 45 rupees. So 425 minus 45, which is 380. Is that clear?
Yes, sir.
Absolutely clear or little bit clear?
Partially clear.
Okay. So put options value, you know how to calculate, right?
Yes, sir.
So how do you calculate? Strike price minus market price. In the first scenario, market price has gone to 0. So the value of the put option is 425 minus 0, 425, right? Is that clear?
Yes, sir. We'll just look in. I mean, later on, we'll once again go and look into the something which is reality going on, so that we get a better picture, I guess.
No. This the value of the put option is calculated the same, whether it is Nifty or anything. It is just market price, strike price minus market price. So in this case, you have a 425 put option, right? Yes?
Yes, sir.
Yes. So the strike price is 425.
Okay.
And the market price is 0. Scenario number 1.
Yes, sir.
So 425 minus 0 is the put option value.
Okay. Yes, sir. I understood now.
So in this case, we will say that we will only look at intrinsic value. We are not counting time value. The time value is counted in the premium. Okay. So we are finding the intrinsic value of the put option minus the premium paid. Why? Because you are paying the premium. You are not collecting the premium. You are paying the premium. You bought the option, right?
Yes, sir.
So you are paying the premium. Is that correct? If you buy an option, you pay the premium. If you sell an option, you collect the premium. Correct? No. Think of anything. You are buying something in the market. You are paying money out of your pocket, right?
Yes, sir. Yes, sir.
And
We got it.
And if you sell your goods, you're getting money for it, right?
Yes.
So gain or loss on the put option, you find the intrinsic value of the put option, which is 425 minus 0, minus the premium you paid out of your hands.
Yes, sir.
380. Is that clear?
Yes, sir.
Okay.
It's clear now. Thank you.
Okay, fantastic. Yeah, it has to be absolutely clear. Otherwise, you will get lost in no time in this. So, so 380 is your gain, but stock has gone to 0. So 440 is your loss. If you add the two, you will get 60 rupees loss. Is that right? Minus
Yes, sir.
yeah. So
Minus.
now imagine this. If you didn't have the put option, you would have lost all 440, right? Correct, no?
Yes, yes, sir.
So the put
Now
option,
the
yeah, put option is limiting your loss. That's the point. Now you can take the next. Yeah, go ahead.
so under this strategy, they are just asking us to take both call and put option simultaneously.
No call option, only put option. You have the
I mean,
stock with you, underlying stock with you, and you are protecting it with a put option.
okay.
No call option here, only put option. Why do
Yeah,
you
a
take
stock
put option?
option along with the put option. Yes.
You are taking, you have the stock with you. Yes, you are owning that stock in an account somewhere. And in that same account, you are buying a put option to protect yourself in case it goes down.
Yes, sir. It's clear now.
Is that clear?
Yes, sir.
Mahesh, clear? Gurleen,
Yes, sir.
clear? Yeah? Okay, now, what about the next scenario? Stock is 150. Same logic applies here. Yeah. So in this case, gain on stock is once again a loss. 150 minus 440 minus 290. And what would be the value of the put option? 230. So once again, you'll get 60. So as long as the price is below 440, you will get a small loss, but much smaller than the loss that will happen on the stock itself. Okay. So basically, if you didn't have the put option, you would be losing 440, 290, 230, 90 like that. So the put option is minimizing your loss. Okay. But when the stock starts going up, the put option will just go worthless and you have to subtract the premium. So let's look at 440. When the stock is exactly at 440, what happens?
The market price and the option price are same, so it becomes nil, and the premium paid is
yeah. So the value of the option is also zero because it has become out of the money now. And you have to subtract the premium you paid. So 45 rupees you would lose. Okay. That's your net loss. Net loss is just the amount you paid for the premium. When it gains in value, whatever profit you have, again, this option's value will not be there because above 440, it is out of the money. It will expire worthless. So 45 rupees loss. So above 440 and above, you'll have that 45 rupees loss coming and it will reduce your profit by that much. So remember, a protective put will help you out when the market declines. Yes, it's not going to help you out when the market goes up. You should understand that. So as long as the market goes below 440, you are getting protection. And that is the goal of this. Usually we will take protective put for a short time. Once we feel the market has started, finished going down, you sell the option and take your profit. That's what you do. But remember, with the protective put, because a premium is paid, you will always have a small loss. You cannot entirely be free from loss, but your loss will be considerably less when compared to what would you have lost if you didn't have that protection. That 60 rupees loss will always be there. Okay. But it will not be as high as 440 or 290. When it's going well below 440, it was going to reduce your loss. Yes, students?
yes, sir.
Any questions? So there's something called a break-even point, which I have mentioned there. So that point, so below 380, right? You're going to be below 440, you're going to be protected. Yes, don't ignore that break-even point for now. But so below 380 or so, the protection will work very, very, very well. Okay. So if you look at the graph, you can see. So as long as the strike price, for now, don't ignore all these break-even points and stuff like that. We don't even need this. So what you should remember is, as long as the price is below 425, you're going to incur a small loss, but it will protect you against bigger losses. After 485, you will actually start making profit. Okay, never mind. All right, students, is that clear to you?
Yes, sir.
Yeah. Ignore the earlier breaking point thing. This is just how it will work. Now, assuming the reverse. Now, what happens if you have a short position? Right? You are betting that the shares will decline, but you think in the short term it may move up. Then you can buy a protective call. Remember, it's the reverse of what you're doing here in the previous case. Here you've already sold a stock short, but you think in the short run it may go up. Yes. So for that, what we will do, we will take a protective call. So students, since this is a very strong topic and new topic, this is why you can understand why I wanted all of you to be there. So if students just look at the video, they may not have a clue of what's going on. Right? Would you agree? But they have to figure it out themselves and they have to ask me because it's kind of tricky. It will take some time for you to observe because you have to understand the intrinsic value of the option very well. Okay, students? So please do go over this. Yeah, please do go over this again and again and familiarize yourself with the topic. Can we create this thing in...
Sir,
Yeah, go ahead.
actually, we're not able to short the shares, right? Unless it was futures.
You are absolutely correct. So in Indian market, we can only short in the futures market. But in America, you can do it directly. So we will assume we can do it here, Mahesh. How about that? Only in intraday basis, they let you go short in the cash market. But we will assume we can do it. The reason is this is why the Indian market is not very stable when it moves down. I think SEBI has banned short selling in the cash market, which I think is stupid. So if they were allowing short selling to happen, when the market goes down, what will happen? Short sellers will cover their short and stabilize. So this is why sometimes the Indian market goes down 5, 6, 7%. Why is that? Because there are no short sellers, there's nobody to cover. Okay. So that's a good point you make. Is that clear, Mahesh? Did I answer your question?
Yes.
Yeah. Okay, so now let us look at this scenario. So do you guys understand the scenario clearly? So we have a short position now and we are hedging it with a call because we think in the short run, it may go up. And we are looking at different prices and expiry ranges and see how we can protect yourself with a call option in case it goes against, in case a short position were to go against you. So all of you understood this scenario? Okay, students. Yes, may I go ahead?
Yes.
Let me see if I can create this. Say reset. So a protective put would be, so we will do this with futures here. Okay. Okay. So we'll say futures. Okay. So futures, Nifty, we'll say add. So remember, in futures position, since it's directly selling a futures contract, you can see actually the probability of success is more than. Okay. So now to this futures position, I would add a put options. I would do put option to protect myself, the previous case. So we'll buy slightly out of the money. Nifty is we'll buy 16,000 put option. And we'll make put option. So add position. So now you can see that the probability of success in this trade is about 64,000. So we are long a futures contract, yes, and put. So you'll see break even is what? 16,473. Yeah, students. So what should happen here is very simple. If the price goes above 16,473, I keep making money. Yes.
Sir, in this example, we're shorting futures, right?
Hold on. What have I said? Oh, this should be buy.
No. Futures was we're selling the futures, so we have to bought calls, right?
No. This is the previous scenario I'm creating. Previous scenario. Buy futures, sell put. Buy put. Buy futures, buy put. Protective put. First scenario.
Yeah, okay.
Okay. So you can see this. So the break even is 16,800. Yeah. So above that, we are going to get profit above 16,889. We are going to get profit, non-stop profit. Yeah. So technically, the maximum loss should be limited to only 248.
Sir,
So
maybe put was also in a sell order on there.
let me see that. Let us look. Oh, put should be buy. Thank you for that. This is correct. So your maximum profit is undefined. Your maximum loss is only 248 into 50. That is 13,600. Yes. So if the so this will give me a lot of money if the market keeps going up. So what is the break even here? 16,474. Above 16,474, Okay. I'm going to be making money. Correct. So
Yes.
below 16,474, I'm going to be making the same loss. Is that clear? My loss is limited to 13,675 or the premium paid, which is 248, lot size is 50, 248.3 into 50. But look at the probability of profit, students. What is it? Only 35%, right?
Yes.
Yeah. So that's the thing. Your profit probability will come down because your hedge is there, but it will protect you against loss. Remember, protective put is going to protect you against loss. Okay, students? Yeah?
Yes, sir.
Yeah. So you understood the logic, right? So the graph should look like the same graph we just saw in the other case. Does it look like this? Like that? Yeah?
Yes, sir.
Yeah, same graph, right? Yeah. Like that. Okay. Any questions? So now let us look to the second scenario where we have a short position. Okay. And we want to take a protective call option. Let me brush up the call option fundamentals. How do you calculate the value of a call option?
So the call option is the strike, I mean the market price minus strike price.
Correct.
Hello.
Yes. Yes, that's what it is. So that's what we are going to use, that concept. So now let us look. So stock price, remember, is again giving you a lot of scenarios here. 0, 200, 458, 540, 650, 750. So at 0, obviously, what have you done? You have shorted the stock. We are very happy if it goes to 0, 510. So what strike price have we taken, students? 540.
5.
So 540 call option at 510, its value is 0, right? Yes, it's an out of the money call option. Remember, think of this, that we are doing this on the last day of expiry. So there is no time premium as of now, but you have already paid the premium that you will subtract. Remember, protective call means what? You have bought a call option. Once again, premium is going out of your pocket. Okay. Is that fine? Yeah.
Yes, sir.
So what is the value of this call option? 510 call option. Market price is what? 510 minus strike price 540. So you can't have a negative value or anything there. So there is no value. It is an out of the money option, which means its value is 0. Is that correct? So out of the money option on expiry date will have value of 0, right? Yes?
Yes, sir.
Yeah, so there is no intrinsic value. We already paid 52 premium. So loss on call is 52. Gain on stock is 510. So we have a net gain of 458. So when there is a gain, when the stock falls, this will reduce our gain slightly. But when the stock goes up, it will protect us. So let us take a situation when the stock is actually, at what point did you sell the stock? 510 you have sold. 510 you have sold. So when stock price goes above 510, you're going to make a loss. So when it goes to 540, yes, what happens?
There's a loss
There's a
of
loss.
30.
There's a loss, and plus you also paid a premium. The value of the option is still 0. So you have an 82 rupee loss. Is that correct?
Yes, sir.
How about when it goes to 650? Now your losses are increasing. Okay. But since you have a put option, a call option, the call option is going to gain in value and protect you. So when it goes to 650, your loss is 140, but your call option is going to gain something. How much is it gaining? 110 minus 52, 58 rupees. So it protects you and reduces your loss from 140 to 82. Is that clear? So you will have some loss of 82 once the stock goes up. That is the loss because you are paying a premium. 82 is the loss you will have always if the share, but it is much lesser than the loss you will have if you don't have the call.
It's a maximum loss.
Yeah, so basically the maximum possible loss is reduced from infinite to 82. Is that clear? Students?
Yes, sir.
Yes, sir.
Yeah. Any questions? So the graph will look like something like this. Reverse of the previous situation. You'll have a lot of profit as long as the stock is falling. But once it starts going up, your loss is limited to 82. Okay, students, any questions? Now let's execute this in Opstra Edge. So what must I do, students? You tell me, help me with this. So here, I'm going to first sell futures. I am taking a short position. I'm going to sell. Is that right? Yeah, students?
Yes.
Okay. Now what must I do? I will add a protective call. Options. July 6,200 call option. I will add it. Add position. Is that correct? Shall we add in the money or out of the money? Maybe slightly out of the money. 16,250 we will add. Okay, we'll add 16,250. Add position. Is that graph looking like that? So your break-even point is 16,359. So maximum, hey, did I do something wrong here?
Sir, option was in sell mode.
Option was in sell mode. Okay. Option should be buy. Protective put buy. Modify. So maximum loss is only whatever minus 30. So it's again limiting your loss. Yes. Maximum loss is limited. And maximum profit is what?
Undefined.
So maximum profit is potentially unlimited because, well, it is limited to actually whatever it is. So Nifty cannot go to zero. So somewhere near that. So, but the graph looks the same, right? Is that right? Go back. Yeah, there you go. Very similar. Yeah. So because you sold the futures contract, your maximum losses, Nifty can go technically to zero, but till that, right? So your maximum gain would be Nifty's value today. But your loss, which was previously infinite, is now limited to 13,000. Yes. And again, the probability of profit is reduced because you have a hedge. So basically, in these two scenarios, your call and put options are acting as your hedges. Protective call, protective put, and protective call are acting as the hedge. Is that clear to you, students?
Yes.
Any questions?
Sir,
Yeah.
like
Yeah.
these call and put options are acting as protective hedge.
Yeah.
And do we still have to rely on the probability of profit? Like, do we still have to wait? I mean, look into that, it has to be above 50%.
When you have a protective put or protective call, your probability of profit will never go above 35%, unfortunately, because the profit potential is reduced with the hedge. So around 35% is what you should look at. Yeah. Now, if you want to improve that probability slightly, what you can do is you can edit the position here and make it in the money. So if I say I would buy a 60 instead of 16,500, let's say I made 16,100 in the money. If I say, oh, that profit is even going up because the break even is pushed up, right? Break even is pushed down, so potential profit even comes down. Maybe we make it out of the money. So you have to just play around with it, but I don't think you can significantly improve this number. So let us say I make this 16,400 out of the money. Look at that. So when I am doing out of the money called as a hedge, then your probability of profit goes higher.
And the maximum also increases.
And the maximum loss also increases, correct? So that's the problem, right? So it's a risk reward trade-off. Yeah. So if you want to limit your loss, then you have to be in the money. If you're okay with the other way around, and your margin requirement also increases a little, right? So when you're having in the money option as a hedge, it's going to act as a better hedge. It will start acting as a hedge immediately. However, the out of the money option will act as a hedge only if the market rallies beyond that point, right? So hence your profit potential is more, but your maximum loss is higher. Yes, students, is that clear?
Yes, sir.
Yeah.
Yes, sir.
Okay. Now, this I like a lot because this spread strategy is usually used by most professional investors. So if you are thinking the market is going up, you can take a bull spread. If you take if you think the market is going down, then you can take a bear spread. Okay. So, so in this case, let us look at each one of those. So before that, let me see if I have a video on something we discussed. So one of the things I said was discussed is good traders make money writing options, right? So income generated, and in fact, you saw that your probability of success is more when you write options. So here is one of my friends, and who's a very good trader in himself, Mr. Vijay.
Hi,
He's
this
going
is
to
Vijay
explain to you
Bhagwani,
how
and
option.
I'm still recording my videos from my residence. I hope the markets are treating you well. You have your finger on the pulse of the market and you're watching what's happening in the financial markets all around you. In my past videos, I have often talked about and elaborated upon why generating steady income or passive income or even income from fixed income securities is absolutely critical for traders who are basically relying on trading the financial markets for their primary source of income. The reason is not very far to seek. In brief, let me just recap about what I have normally elaborated upon in my other videos. While you're battling the markets, while you're trading the markets and you're navigating through the markets, weaving in and out of the traffic, as it were, you cannot keep yourself preoccupied about your home and hearth expenses, or what you'd want to call survival expenses. That has to be taken care of by your fixed income or other income, so that you don't you're not forced to square up your transactions because of want of finance. So you basically twin track or even multi-track your income sources, so that no one activity infringes or forces you to act against your intended blueprint because there is a cash crunch in another line of activity. That is basically the modus operandi or the prime actually focus on what we are trying to do here. Let me talk to you about a kind of service that I offer through Equity Master. It's called the Fast Income Alerts. It's about option writing. Here we try to sell options so that we collect the premium. Now the buyer of an option pays the premium. Here we are trying to sell an option. The modus operandi or the prime reason for selling the option is to receive that premium. So that premium becomes the income. Your investment is the span margin that you pay for selling that option or writing that option. So the return on investment is calculated as the income earned on the investment, which is the span margin paid to the exchange through your broker. What we do focus on in the Fast Income Alert service is primarily the most liquid counters in the financial markets, which is the Nifty 50, the Bank Nifty, and the USD INR. Primarily, the focus will be on the stock indices, not so much on the USD INR, where of course there will be trades, but they will be far and few in between as compared to the Nifty and the Bank Nifty. If you care to check your statistics, you will realize that a lion's share of the turnover in the derivatives segment comes from the indexes, the Nifty 50 and the Bank Nifty. So since these two indices are the most heavily traded counters, where the bid and the offer prices, the difference between the buying and the selling quotes is very, very small, it actually becomes very easy for a trader to get in and get out of a trade. And your execution costs tend to be lower because the slippage or the difference between the two prices is very narrow. The USD INR, when it does give a trade, like I said, these trades will be fewer and far between. The USD INR, when it does signal a trade, again, is a very liquid counter. It's not difficult to get anything between 15 lakh to 22 lakhs, 23 lakh lots being traded in the futures segment in the USD INR. Therefore, the options on the USD INR are also fairly liquid. So navigating in and out of these counters is not really a problem. This scheme is an income generation scheme. This is not a multi-bagger scheme where you will double and triple your money in a month. This is not a stock trading scheme. This is to earn a rate of return which is calculated in percentage terms on your investments. Most of the times what you will get is a rate of return higher than the bank fixed deposits. Once in a while, you might get above average returns also. As in all financial market trades, there are always trades that surprise. Is this a bulletproof, risk-free trade? No, not at all. I'm not saying that there will be no losses at all. There will be a couple of months where you might even have to hit, you'll see your trade hit your stop loss and you might lose a little bit of money. But like I said, this is an income generation scheme. So your return, if it is say hypothetically 1.5%, 2%, 2.5% on investment, your stop loss and therefore your loss will also be commensurate with your return. This is not something where you will lose 20% or 30% of your capital in one trading month. So to that extent, this is a scheme where
Hi, everyone. Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. This is your State of the Market. You know, I've gotten a lot of feedback from viewers who want to know more about options. So today we're going to talk about options. It's going to be kind of a primer for you. And then next week we'll get into some more advanced strategies. Options can be used to generate enormous profits, or they can be used to hedge current positions. So they're a very versatile tool that every investor should at least know how to use. So let's get started. There are two types of options, calls and puts. A call gives the buyer the right, but not the obligation, to buy a stock to call it away from the option seller, and they can do so at a certain price by a certain date. The seller of the call has the obligation to deliver that stock if the buyer demands it. So for example, let's look at Qualcomm. If Qualcomm was trading at $123, a call buyer could buy the November 130 calls for $7. And that means that the buyer of the option has the right, but again, not the obligation, to buy Qualcomm at $130 at any time before the third Friday of November. Options usually expire on the third Friday of the month. $130 is what's known as the strike price, the price at which the stock transaction would take place. Options contracts represent 100 shares. So if you buy one call, you can buy 100 shares of stock. And for that right, you're paying $7 per share or $700. Now, wait a second. With Qualcomm trading at $123, why would you pay $7 for the right to buy it at $130? Well, if you bought 100 shares of Qualcomm at $123, you would have to pay $12,300. Buying a call contract only costs $700. If the stock goes higher, as you expect, your calls will increase in value, or you could pay $130 for the stock, even though the stock might be trading at $140 or $150 or higher. Most options investors don't exercise their options or make that stock transaction. Rather, they're looking for the call to appreciate in price and profit from trading the call. So if by November, Qualcomm was trading at $150, the calls would be worth at least $20 and likely more. So someone who bought the stock would have made $27 or 22%, but a call buyer would have nearly tripled their money. The risk is that the stock does not go up to $130 by expiration. If the stock goes nowhere and is still sitting at $123, someone who had bought the stock still owns it, they're flat, and there's an opportunity that the stock could go higher at some point in the future. A call buyer's option would expire worthless, and they would lose their entire $700. Now, of course, they could sell the option at any time before expiration. You don't have to hold it to expiration. So maybe if they sold it in October, they'd only lose $350 instead of the entire $700. That's up to you as the investor. You can sell it at any time. But it's important to understand that even if the stock rose to exactly $130 at expiration, that call would have no value. Only above $130 would the call have value. Meanwhile, if you bought the stock at $123, you'd have a $7 profit if it's trading at $130. So by purchasing a call, you can participate in a stock's upside with less upfront capital. You can make tremendous gains, but the risk is higher and you can lose all of your capital. So that's calls. Let's now switch to puts. When you buy a call, it's a bet that the stock is going to go higher. A put is a bet that the stock is going to go lower, and it can also be used to hedge an existing stock position. Using Qualcomm as an example again, trading at $123, a put buyer could buy a put, let's say the November $110 puts. That means that at any time by the third Friday in November, the put buyer can put the stock or sell the stock to the put seller for $110. Now, obviously, if the stock is trading above $110, you wouldn't do that. But if the stock is trading below $110, you could force the put seller to buy your stock from you at $110, or the value of the put would increase and you could simply take your profits on the put itself. Now, this is important to understand. You don't have to own a stock to buy a put. You can buy a put purely as a bet that the stock is going to go down. If Qualcomm drops in price, then the put becomes more valuable. Let's say Qualcomm totally blows its third quarter earnings and it's a disaster and the stock drops to $90. Well, if you bought the November $110 puts for $5, if the stock is trading at $90, that put becomes worth at least $20 or a 300% return on your money. Like with the call, you don't have to hold it the entire time. You can sell it anytime you want to before it becomes worthless. So you may still lose on the put, but it doesn't have to be 100% of the value of the put, even if the stock does not trade down to $110. Investors that own the stock can use a put as a hedge, kind of like insurance. So for $500, they can insure themselves and protect themselves from downside worse than, let's say, about 10% if you're buying the $110 puts. They own the stock at $123 and can sell the stock at $110. So in the case of a disaster, like the stock falling to $90, the put becomes worth $20. So even though the stock is down $33 because you bought it at $123, when you add the profits from the put, it results in a loss of just $13. Now you can buy puts at your cost basis so that you're guaranteed not to lose any money, but the puts will be more expensive. It's just like insurance. The larger deductible you have, the larger loss you're willing to take, the cheaper your premiums are. The less loss you're willing to take, the more expensive your insurance will be. So buying puts and calls is a great way to make big money without using a lot of capital to invest, as long as you can handle the higher risks that come with trading options. Now, next week, we're going to kind of flip the script a little bit. Next week, we're going to talk about how to generate.
Okay, students. So is that clear? What was being discussed? Just a summary of what we discussed in options, etc. Okay, students, I will open up the session for questions on anything we have discussed in the class up to now. Anything else? Any concepts, market moves, anything else you want to know? Yes?
So nothing from my end.
Okay, others?
Nothing, sir.
Yeah. So the spreads I will take up in the next session, next class, because otherwise those guys who are missing today will miss out on quite a bit. We can look at anything related to the market in the next 5 minutes. Anything else you want to have a discussion on? What else would you like to see in the class? That's something I ask every class. So is this pace comfortable to you? I need to go a little bit more slow, you think? Or what is your opinion there?
Sir, could you please send the links of those YouTube videos in earlier so that we can prepare for the class and come?
Oh, these videos are just basic videos. You can just Google YouTube. You go there and just do the put the topic in. You will automatically get the basic video. I have put them all in a saved thing. I don't know how I can send all of them to you in one go. But the video will not prepare you much for the class. Just watch the Sensible channel, YouTube. Subscribe to the Sensible. That should be enough. Be
Yes,
sensible. They have a video on every trading day. If you watch that, you are set. The others are very entry-level basic videos. That one I think will not add much value, but Sensible, every day they have a video in Hindi and English. Either one you watch, that will get you market prime.
Yes, sir.
Yeah,
We'll look
subscribe
into
to the
it.
Sensible channel. I think it's called Be Sensible. Any other queries other than that? Do you have access to the videos?
Yes, sir.
Recording? Every day you are getting the recording of the classes?
Every week. Yes, sir. We'll get the link by 1 or 2 days.
Okay.
Not an issue.
Okay. So then if you have the recording of the class, you can go back, review it. And if there are any questions, you can ask me via WhatsApp if you need immediate clarification. By the way, this was my market view last time. I do write about it. So if you look, I basically track all the asset classes and look at their implications for the Nifty and the US market. So last week's indicators were actually bearish. So, but I had given 2 levels. Okay. So if you go scroll down this, so this report will come to you Monday. The levels were 58.50 up and 15.650 down. So above 15.850, we were bullish. Below 15.650, we were bearish. So this is the last paragraph is what you have to watch for levels for the coming week. So I think next week we are looking at levels of 16,300 on the up, I think, and 16,150 on the downside, if I'm correct. So you can have a look at this report also. So this will give you some additional market information. Other than that, anything else you want, students?
No, sir, it's very clear. Thank you.
Okay, and what about the pace of the class? Am I going fast, slow, correct?
It's good, sir. I mean, for me, it's fine. I have no issues.
Okay. What about the other students?
Fine, sir.
It's fine, sir.
Okay, okay. So if there's something that is needs to be tweaked, we can always tweak. So I tried to follow the news pretty systematically. So I think you should also do that. I mean, if you ever are going to be, I was part of a hedge fund setup in the US. I don't know whether I have mentioned it to you, but back in the day, so watching the market was my job. So I do that even though I have long left that position. I mean, I still keep doing that. So I think you have to train yourself to be in tune with the market. I have a view whether it is bullish or bearish on the market and substantiate it with a lot of facts. So ultimately, that's what gets you into a career in this domain. So if you have good market understanding and knowledge and can build on it, nothing like it. So make use of that. Okay, students, if that is all there is to this, then we'll see you next week. I hope there is more students can join in next week, because I think the topics are going to be very interesting, and I'm going to be showing these live strategies like what we did today. And you guys have to create those strategies and find the most profitable 5 or 6 very profitable strategies you must find using that Obstride site and submit it ultimately. That is your assignment number 2, which is for 20 marks. Your simulation is 30 marks. So 20 marks for 20 trades that you are going to be submitting, plus a 10 mark situation of review of actual trades. Okay, students, is that fine? Do you understand the 2 assignments clearly?
Yes, sir.
Okay, so start working on them. And next week, Kirti and Gurleen, you go over a few trades you have done, yes?
Yes, sir.
Okay, all right. Thank you very much then. See you all. Have a good week.
Thank you, sir.
Thank you, sir.
Thank you.
Good day.